Hello, everyone. My name is Tom Taylor. I'm head of legal and regulatory policy at the BVCA. We're the industry association and public policy advocate for the private equity and venture capital industry. We represent over 300 private equity fund managers, over 100 investors in those funds, plus about 300 advisors. So I'm going to talk to you briefly about how responsible investment practices have developed in this industry. I guess you could say of their own accord, and then cover how incoming sustainability regulation, particularly of the EU variety, kind of maps onto that existing commercial practice. So in terms of existing practices, I think it's fair to say that most private equity and venture capital firms now look to mitigate at least the ESG risks within their portfolio companies, and also that an increasing number of firms are also using ESG as a kind of lens to unearth opportunities for value creation as well. And they often use a range of different tools and frameworks to do that, mostly that have been developed by industry itself. So I'm thinking of the UN principles for responsible investment, SASB, GRESB, even TCFD has quite a strong industry-driven component to it. So this industry-driven trend of using ESG to improve portfolio companies, I think, reflects a broader momentum behind sustainability and ESG amongst the market and amongst society in general. But for us as an industry, this has been reflected in and driven by more and more focus on sustainability issues from investors in the funds that our members manage. Now, regulators are now building on these kind of organic investor market-driven foundations. Sustainability issues, especially climate and other environmental considerations, are very important to society at large, and they've become very deeply embedded in global political discourse. And that, in turn, has spurred policymakers and regulators to start implementing a whole range of new sustainability-related rules that will soon start to apply to the financial services industry, with private equity and venture capital being no exception. So I'm going to start with EU-level sustainability regulation, in particular the taxonomy and the disclosure regulations, because these are the most important elements of the EU Sustainable Finance Programme for the private equity and venture capital industry. So the taxonomy is very important. It's a groundbreaking piece of regulation, but it's essentially a dictionary of what is and what isn't sustainable, rather than something that imposes obligations directly onto firms itself. Essentially, it sits one level behind other existing frameworks that apply to corporates in the case of the Non-Financial Reporting Directive, or to financial market participants in the case of the Sustainable Finance Disclosure Regulation, or SFDR. And so it's those frameworks which actually oblige firms to use the taxonomy in certain ways or for certain products. So SFTR is the key one of these directly applicable frameworks for the private equity and venture capital industry. It applies more or less to all EU regulated financial services firms from the 10th of March 2021, although some of the detailed requirements probably won't apply till January 2022. SFTR catches UK private equity and venture capital firms in two key ways. Firstly, because a lot of our member firms have EU-regulated fund managers or funds, AIFMs or AIFs. So they're caught directly by these rules because they're regulated in the EU by EU supervisors. And then secondly, because a lot of our member firms, although they're regulated in the UK by the FCA, they nonetheless market their funds to investors that are in the UK, and so products marketed to EU investors are also caught. SFTR, it imposes a whole range of new sustainability disclosure requirements on these firms and on their products. So there are requirements about what types of information firms have to disclose, which includes anything from relatively simple things like ESG policies, as well as more complicated things like data on the principal adverse impacts of the firm's investment decisions on society and the environment. Some of the disclosure requirements are focused on individual fund products, whereas others on a firm or a portfolio-wide basis. And then there are different pieces of information. Different pieces of information need to be disclosed in different ways. So some things have to be disclosed publicly, i.e. on a firm's website. Some things have to be disclosed periodically to investors, i.e. in annual reports. And other things have to be disclosed pre-contractually, so in marketing materials to potential investors. And in our industry's case, that's in private placement memoranda or PPMs. And then there are different levels of information that need to be disclosed for different types of funds. So at one end of the spectrum, you have standard funds, shall we say, that don't particularly emphasize ESG. Then you have funds that are sold as particularly focused on ESG. And then at the other end of the spectrum, you have impact funds for whom a positive social or environmental impacts are a kind of priority element of the fund's investment policy. So there are different levels of disclosure requirements for each type of product. And that's broadly how SFDR works. Now, because much of the private equity and venture capital industry is already to some extent familiar with ESG reporting because of this growth in demand from investors over the past decade or so, much of this framework, this regulatory framework, has to be mapped onto firms' existing practices. So firms are busy working out at the moment what they'll need to change, what they already disclose or can disclose, what they'll have to introduce new systems for, and then what information they'll need to gather, what new information they'll need to gather from portfolio companies in order to comply with these rules. So the answers to many of these questions will vary depending on the firm and the product. In particular, what size the firm is, so how much resources it has. Also where it sits on the spectrum of experience. So experience of providing this information, this type of information to investors already. And then where the firm sees itself in terms of ambition on ESG matters will also come into play here. In particular, whether the firm wants to be on the front foot on sustainability and essentially use it to gain a competitive advantage when fundraising from investors, from LPs that might prioritize. That's often because the investors themselves have sustainability regulation that they need to comply with as well. One reason why firms in our industry have been finding it perhaps challenging to answer some of these questions on how to implement SFDR come from a lack of clarity in a number of areas of the rules. And I'm just going to pick out a couple of the most important of these grey areas now. So the first of these relates to principal adverse impact statements, or PAI statements. Now, this is a new requirement for firms to disclose publicly the impact of their investment decisions on society and the environment. So whereas ESG traditionally has been about the world's impact on portfolio companies' value, this is a requirement for firms to look at more closely at the portfolio company's impact on the world. So in that sense, it's a new departure. And the EU regulators came up with a very long list of KPIs for firms to disclose in these PAI statements. And these covered everything from scope 1 to 3 carbon emissions, gender pay gap reporting, biodiversity issues, and a whole range of other sustainability concerns that firms would then have to gather information on from their portfolio companies and report these publicly. Now, these KPIs, there were 32 of them, are very wide-ranging, onerous potentially, and difficult in truth to collect. And the rules really lacked any elements of materiality and proportionality. So it was quite difficult for a lot of firms to comply with this statement. But there is an option for firms that have less than 500 employees to opt out of this very precise, prescriptive PAI template. But in order to do so, they have to make quite a bold statement that we do not consider the principal adverse impacts of our investment decisions on the environment. Now, that's both arguably a bad look for firms that might be proud of their approach to ESG, and it also might be factually incorrect for many firms who do consider at great length their impact on the world, just not necessarily in the very precise, formulaic manner that was prescribed by these draft EU rules. So this is something that firms have really been grappling with, how to balance, on the one hand, this belief in their own approach to sustainability, belief in sustainability generally, with, on the other hand, the fact that it would be very hard to comply with this voluntary PAI statement. The most recent draft of the detailed rules, the ones that will apply from January 2022, has kind of pared back this list of PAI indicators to an extent. So it's going to be interesting to see whether firms feel they're now practically they are able to opt into this statement because the burdens become a little bit more reasonable in the latest draft. So the second important grey area I wanted to mention is around product classification. Now, this is about the more extensive anti-greenwashing disclosure requirements that are being imposed under SFDR on funds that are marketed as being particularly focused on ESG. They're known as Article 8 funds, and on impact funds, so they're known as Article 9 funds. So there's quite a lot of confusion in the market about whether a particular fund product will fall into one category, into the other, or into neither. From a practical perspective, that's quite important because these types of funds, so the ESG funds and the impact funds, under SFDR have to use the EU taxonomy to disclose on the environmental elements of the sustainability investment. And that brings cost implications. So smaller firms in particular might want to avoid their funds being labelled as Article 9 or Article 8 products if the accompanying compliance burden is too great for a smaller firm to handle. But there's also a very important investor relations angle which kind of tugs things in another direction. So many firms will want to ensure that their products do fall into either of one of these brackets in order to attract investment from LPs for whom sustainability is quite an important issue. And we're certainly seeing an increase in questions from investors to fund managers about this categorization. Unfortunately, there's been quite a great deal of uncertainty in the market about what features of a fund will trigger these extra reporting obligations, and therefore the use of the taxonomy. For example, whether or not standard investment exclusions such as no investment in tobacco might pull firms into one of these categories. So we're waiting for further clarity from the Commission on that with interest. So that's a very brief overview of SFDR, how it interacts with the taxonomy, and how they're both beginning to affect a private equity and venture capital industry that had already developed its own approaches to ESG reporting. I just wanted quickly also to mention what's going on this front in the UK. So the UK hasn't copied the taxonomy or SFDR into its own rules yet, because their application date fell after the end of the Brexit transition period. So the UK wasn't obliged to onshore these rules. But sustainability, and in particular climate, it really is, as I'm sure you're all aware, a key policy priority for the UK government, which has announced that it's going to roll out TCFD-like climate reporting requirements all across the UK economy over the next 2 to 3 years. However, TCFD is much narrower than SFTR because it's just focused on climate. And so the Treasury has already stated that it's still considering whether to bring in SFDR-like rules in the UK. Well, we'll have to see how that pans out, but we would hope that any UK equivalent of SFDR can learn from the difficulties that the EU rules have faced in terms of grey areas, materiality and proportionality. So that's all I was going to say. Please do contact the BVCA directly if you'd like to discuss any of these issues any further. Otherwise, thank you very much for listening.
Thank you, Tom, for those very helpful insights on the direction of travel for EU regulation in this area. I was particularly interested in your thoughts on the grey areas, product classification and principal adverse impact statements, as I have heard other experts in this area mention these as potential problem areas. To introduce myself, I am Felicia de Laat. I'm the head of funds for Mourant, Ozannes, Jersey, and I'm here to moderate a panel with some very interesting speakers on the same topic of sustainable finance. So let's head now to the panel.
I'd like to welcome today, we're delighted to have with us Dr. Stephen Pringle, who is the Director of EMEA for the Global Real Estate Sustainability Network, otherwise known as GRESB. Dr. Vian Sharif, who is at the Head of Sustainability at the FNZ Group, and Dr. Desné Masie, who's the Chief Strategist at IC Intelligence. And finally, but last but not least, Frances Watson, who is a partner in the Guernsey office of Mourant Ozannes. If I could hand over to the panelists just to give a brief introduction to themselves and a little bit of their background in how they came to be interested in sustainability. Can we start with Stephen?
Thank you very much for the introduction. I'm not quite a doctor yet, I must say, just as a clarification. I did start my career as a nurse, so I was fairly close. But yeah, so my name's Steve Pringle. I'm a director at EMEA at GRESB. We're a sustainability benchmarker and reporter on behalf of largest institutional investors and pension funds, insurance groups, and then fund managers and asset managers across the world. So I'm originally from Australia, working for GRESB, living in Amsterdam, and come from a real estate funds management banking background post nursing. So thank you.
Thank you. Vian?
Yes, thank you. My interest in sustainability came during my career at Investec Asset Management, where I suddenly started understanding the role of investment in shifting to a more sustainable world. And during that time, I became very, very interested in African conservation and started to see how this whole global system starts to come together. That prompted me to do my PhD in environmental behaviours between Imperial and Oxford, and then to transition fully into a very exciting area, which is the role of technology in achieving some of the sustainable outcomes that we're all hoping to get to as a global community.
That's fascinating, thank you. Desné.
Hi, yes, like Stephen, I've done quite a few things in my career, journalism, finance, and also academia. I actually did my PhD on media, and that's really the space that I work in. I work in thought leadership and strategy. So I help our clients tell their story. Sometimes that is in strategic communications or reports, do research. And my interest in this area, I actually been writing about sustainable finance for years, you know, way back in the days when it was called socially responsible investing, and people used to sort of, you know, pay attention to these issues through charity work. And, you know, it's developed amazingly over the past decade. I'm delighted to see you know, the interest and the momentum with capital. And, you know, one of my big inspirations, actually, I used to work with Vian at Investec Asset Management, and we used to talk about these issues, you know, and try and get other colleagues on board. So good to continue the journey.
Definitely. Frances.
Thanks. So I am a partner in the Funds Channel Islands team of Mourant Ozannes. I'm based in Guernsey. I've been working in law for 20 years, 15 of which have been in Guernsey. I have always held ESG and green initiatives very close to my heart personally. And so it's a genuine pleasure to now be working in an environment where your personal meets your business. I think you actually become a lot more passionate about it.
Thanks, Frances. The first question I wanted to put to the panel was along these lines, which is that given the climate emergency and the other environmental and social crises that we're facing, I think we can take it as a given that sustainable investment and the related laws and regulations are here to stay. And the EU is regulating this space, or leading the way on regulating this space, with their taxonomy regulations and the sustainable finance disclosure regulations. I'd like to start with a discussion on this development. And can I ask Stephen, what are your thoughts in this area?
Well, we're quite excited about SFTR and the EU taxonomy, the new regulations that have come into play. So it sits nicely behind the organisation that I work with, GRESB, which is an optional disclosure, reporting disclosure framework for sustainability. And now that'll be alongside SFDR, which is now mandatory. So that when it, I think was first announced, maybe 1 to 2 years ago, there was a lot of concern amongst the industry and also our members. But I think it's something that's been done before, especially by our members with reporting to GRESB. A lot of these indicators are already covered. So it's will be a bit alarming for some people but that's sort of the kick along that these organisations need. So we're very much looking forward to it and very much looking forward to working with our members to meet these disclosure requirements on behalf of the EU. But I'd be very interested to hear what everyone else says. Everyone else has to have an opinion on this.
Yeah, what are your thoughts?
Yeah, Steve, I fully agree with you. If I come at this even with just a biodiversity lens, I think the opportunity that's being created by the EU taxonomy, even though incredibly rigorous, even though SFDR is going to a level of detail I never thought I would see in this time frame, what an opportunity. It's both a challenge because we have to start to develop insight into areas we probably have never looked at before in the investment industry. And yet, in doing so, what a compelling opportunity to start to really understand things we have never mapped before. So the impact of a portfolio on nature, how gender pay is distributed within companies. They are really, really interesting, exciting developments. And what's also interesting is that given the fund industry and how distribution networks work, especially looking at the situation we're in now today, the people around the table, even though it's an EU disclosure, in fact, those entities who are interacting with the EU, who are distributing into the EU, wherever they are, will take this into account. So it may be the case that all boats will rise because of this kind of disclosure. So very interesting moment.
Yeah, if I could just add to that, I would say I think the kind of leadership in the global conversation that the EU has demonstrated has been very positive, because we've since seen developments in other countries, the UK making commitments to climate, the US as well. We'll see a lot of development. There's already a lot of talk of the Biden administration as to how capital will follow the president's green agenda. But I would say, just directly speaking to the taxonomy, I think, in terms of the level of detail that Vian mentioned, in terms of the assets and the pathways, I think what's great that the taxonomy is offering is that it makes space for a range of asset classes that perhaps didn't have the option before to now find a pathway towards contributing to sustainability and a broader, positive development in the classification system.
I think Guernsey and Jersey sort of sit slightly outside that. Fran, did you have any thoughts on that?
I suppose just really the point to make about where the Channel Islands are, they're obviously not within the EU. and therefore the regulation won't directly apply to them, save to the extent that they're seeking to market into the EU. But certainly the islands, are taking note, and looking at what the EU is doing, and I can see a time, where these taxonomies will converge.
Thank you. And the next question I had, which is related, which is obviously one of the key issues for sustainable funds and impact funds is how to measure and report success, particularly against when you've got non-financial benchmarks. And how do you verify that when often there's like patchy data or no one agreed set of benchmarks? I know GRESB focuses on this area particularly from a real estate perspective, and Vian, of course, you're involved with Benchmark for Natural Capital. Guernsey's green funds as well have a strong focus on verification. So where do you think are the current gaps and issues with reporting and measurement at this moment? And what do you think are the most likely solutions in the near to medium term? I might start with Vian on that one, if you don't mind.
Yeah, sure. It's a really, really valid question. And if you look at where scoring is on non-financials, it's almost perfectly imperfectly correlated. So different providers will use different scores. They'll build them in different ways. It's hard to get to an understanding of how these non-financials are measured. So that's one area. The other piece that's happening, the trend that we're seeing, is that disclosure from companies is starting to improve. And the regulation that we are seeing from the EU, I imagine, is going to start to encourage even more disclosure. So we've seen disclosure really, really start to ramp up. And I think that's a trend that's going to continue. Our view is that the closer we can get to the actual metrics, to the disclosure, yes, we're starting that journey. There are going to be estimations. We're going to have to fill the gaps. That's absolutely right. But I think the trend is going in the right direction for transparency. Benchmark for Nature was an exercise done in conjunction with Oxford University's conservation science thinkers and sustainable finance thinkers to fill a gap which we see in investors understanding the impact of their portfolios on nature. Very underrepresented at this moment in time, but also an interesting case study on where the gaps are and how we might try and fill them.
Thank you. Anyone else like to jump in?
Yeah, I'd really like to make a point to that as well. I agree entirely that the data is key, disclosure is key, and it is a step-by-step process, and it's quite a good reflection of our development over the last 12 years, I guess, and from when we started collecting real estate sustainability data from fund managers, asset managers, listed companies around the world. It was quite qualitative in nature and sort of fairly basic data, but now our investor members, the members of GRESB, are really pushing for hard granular performance data, and that's reflected in our assessments. It's a lot more data which is sort of irrefutable in the whole sustainability realm. So I agree with Vian entirely that it will be a process, and it will get more granular as these disclosures are gaining their requirements and their future existence. But I'd like to hear what Desné says to this as well.
Well, I think for me, I think the reporting issue, and you mentioned performance. I think the reporting is probably the crucial thing here. For companies to know what it is that they ought to be measuring. I listened to it was a Guernsey Green Finance webinar a few weeks ago where the head of Guernsey Green Finance was speaking, and he was talking about the fact that who would have thought that auditors might end up being sort of, you kind of think that Greenpeace hippies would save the world. But actually, if we all buy in things as consumers, and once we can account for these things, measure these things, unfortunately, there's the concept of natural capital that, Vian will know about, which is trying to put the price on a rhino, trying to put the price on, a piece of a conservation area to understand what the contribution to that is. But I think, unfortunately, if people understand these things in financial terms, you know, it's obviously its nature, it's an essential public good, it's an existential asset. But by putting a price on things, we can actually motivate people to take action and to give clear reporting and results.
Another topic in this area, which has attracted a lot of attention, is the idea of greenwashing. Because it's obviously a concern for the public, but it's also a concern for the regulators in this space. Are there grounds for concern, you think, in the investment fund space? Obviously, it is concern in the consumer retail space, but what about investment funds? And if there is a concern, how do you think it's being addressed? Desné, have you got some thoughts on that?
I have many thoughts on this because, you know, as I said, you know, I do a lot of journalism as well, which is great. I get to really say what I think. And also over the years, I've interviewed so many people in the space. And I do know who the veterans are, you know, and the people who've been lobbying and have been really campaigning for this issue to be on the agenda. However, now that there's a lot of capital, I saw a statistic the other day, 17.2 trillion in the US alone has, you know, flowed into ESG, so, you know, that can be described as ESG assets. Globally, around $30 trillion we're sitting at. So obviously there's a lot of interest in gaining market share. And, you know, I think in this ecosystem, I think we should, you know, I'd like to talk about a concept in public economics where we talk about something called the free rider problem. And that's a form of market failure when some people who benefit from resources or public goods or services, you know, they benefit for things that they've not paid for or underpaid for. And it's extremely important that these free riders in the sustainable finance ecosystem are not rewarded for ESG positions that they do not, in fact, have, because this takes away capital allocation from the good actors, the deserving market actors that are actually reporting the ESG metrics, that actually do have, you know, assets in the right place, that have divested from fossil fuels and that have been pioneers in the space. I mean, the other more concerning issue is that it's a form of mis-selling, really. Because, you know, I'm concerned that, you know, it's the interest we're seeing from in ESG, it's created this multitude of investment professionals who are quite recently claiming to be experts in ESG compliance. And it seems to me to be, as I said, a naked and disingenuous attempt to gain market share. But, you know, if the mainstreaming of ESG has made the industry realize that it has to pay attention to sustainability or it'll hurt their bottom line, because I mean, this is just going to be the way business is going to be done now, then that can only be a good thing ultimately. But, you know, that being said, in terms of the issue of making sure that you're buying what you're buying, you know, from the consumer and investor and trustee perspective, particularly for institutional trustees, you know, carefully review the wording of portfolios. Anything that's sold as sustainable or ESG, and this is where the work that Vian and Stephen is doing is so important, because now we're developing a system where we know they really are reporting what they're reporting, and this is the standard, right? Because a lot of managers are claiming to be ESG compliant when they're engaging, or they've just paid attention to something, but that doesn't mean that they're actively positioned. You know, maybe they've just, you know, said, we're not doing this, we're not doing that. We've thought about ESG, but what are they actually doing? It's so important. And then, sorry, I've said a lot. The final thing I will say is that finally these days, I think it's not enough to just avoid assets which are not sustainable. You know, so I'm not invested in mining. I'm not invested in fossil fuels. I think it's important to take an active management approach into ESG compliance and sustainable assets, which is a much more robust investing approach, you know. So, and I think also, you know, as funds, as trustees, I think you need to think, are your professional service providers ESG compliant? You know, are they offsetting carbon? How does your service provider score on gender and diversity, for example? So I think that, you know, if we think about a green and a sustainable approach, I think we have to think the circular economy and how everything in the ecosystem contributes. And that's really where we're trying to get, you know, in terms of a global policy shift on these issues.
If I may, I'd like to build on that and reflect on it with some of the things Steve has said as well, which is, you know, to date, I haven't seen a definition outside the Brundtland report of sustainable. I haven't seen a definition of green. So I think there's two sides to this. There's what what is that? What is sustainable? What is green? It's where frameworks like this taxonomy that's coming in and others like it, and some of the commitments around climate, some of the things we have achieved already, start to become practical and tangible. I would say that the move towards transparency is a big way that we can start to solve this. And that, I think, and I'd be very interested in Steve's views on this, the thing that's different now, and if you look back at the literature, environmental awareness comes around every 20 years or so. There were solar panels on the White House in the 70s. They went away. There was another wave when people came back to this in the 90s, and it's coming back now again. What's different this time, in my view, is technology. Technology has enabled a different kind of access, a different kind of transparency to happen. And that's why I think we can do something very different and very special this time round. But interested in your views, Steve.
I couldn't agree more when it comes to transparency. That is really the leader. That's going to be the tailwind behind disclosures, behind sustainable, what's sustainable, and being able to prove that. We've had 100 years of financial transparency, which has done the world of good for financial markets, and it's only just starting. Well, it's not starting, but it's really getting more tailwinds behind it for sustainability transparency. And it comes down to data, and it comes down to technology working with data. And we're seeing a lot of that with some of the partners that work alongside us and work alongside the fund managers and asset managers that can work on their behalf, collecting the data from their assets, from their funds, and then verifying that data, validating that data, and then providing that to the decision makers in the financial markets. So incredibly important, and some of these organisations are doing terrific work and should be applauded for that.
I think we, from a Jersey and Guernsey perspective, and Fran can chip in here if she wants as well, our regulators are very focused on this as well. Like the Guernsey Green Fund has a strong focus on verification, and the Jersey regulator is also looking at this. So they're aware of the greenwashing issue, and they want to make sure that Jersey's and Guernsey are positioned in the centre of what's acceptable and proper practice, and making sure that people really are doing the sustainable funds and the sustainable investment that they claim that they're doing. A more funds-oriented question, actually, for the panel. Funds are based in a range of different fund domiciles, and both onshore and offshore in international financial centres. And Guernsey and Jersey, for example, have quite a number of sustainable funds already based here. What features do you think are going to be most helpful in attracting and supporting sustainable funds in a fund domicile? What are investors looking for? I might start with Fran this time, if I may.
Certainly, and we've touched on this, and I think it's important to talk about Guernsey's journey in the sustainable finance space. It's fair to say, Fee, as you've just said, the Channel Islands have always recognised the importance for financial centres to adapt to the increasing demands of green and sustainable finance. And the Channel Islands have always had a flexible fund regime with an ease to market, a lower cost base, and pragmatic regulatory approach. And they've been, as you've said, administering clean technology and ESG funds for a number of years. But for sustainable finance, as we've just been discussing, it's very important that investors have confidence in the product. And that's why in Guernsey, we developed the Guernsey Green Fund, which we suggest is the world's first regulated green investment fund product. In creating a kite mark, it essentially assures investors that specific green criteria have been met and that their investments are having the desired positive environmental impact, with the fund being certified either by an independent third party, which has adequate expertise to provide reliable and accurate assessment of the green fund's ability to meet the green investment criteria, i.e. the auditor, or by the Guernsey Fund's licensed administrator or manager. Under the Guernsey Green Fund rules, green funds must invest 75% of their portfolio in investments meeting the strict green criteria, and the green fund's remaining 25% of the portfolio can be invested in other asset classes, provided the investments do not lessen or reduce the green fund's overall objective of mitigating environmental damage. The Jersey government has launched Jersey's carbon neutral strategy at the end of 2019, as well as the sustainable transport policy. The JFSC is also about to publish feedback on its consultation to include disclosure requirements in its codes of practice for Jersey funds. And a new initiative this year is the launch of the Jersey for Wilder World, which is a joint initiative between the Jersey government, the JFSC, Industry and Jersey, and the Durrell Wildlife Conservation Trust. It's a voluntary scheme where businesses with a sustainable focus can donate a portion of their annual fees earned from including SRI entities to Durrell Wildlife Conservation Trust.
I'm quite so excited about what's going to happen in Jersey this year. They've got a lot planned, so it's looking really good. Vian or Stephen, any thoughts? And you're more at the benchmarking reporting end, but from your perspective, I'm sure you have thoughts on this area as well.
Yeah, I think Francis has covered it very, very well in the way that it does exactly come down to transparency again, and the investors who are looking at a sustainable option, sustainable fund, then it's really down to these disclosure regimes and ensuring that these disclosures are robust and measurable, so and therefore they in essence be reliable. That's my 2 cents to that point.
I think the only thing I'd add to the great comments from Francis and Steve is that, in my view, there's still an education piece here for all areas of the industry and retail, all the investors, whoever you are, whether you're a global citizen, whether you're a top fund manager, whether you're a financial advisor looking at these funds. There's still, in my view, a piece around how does investing in this way affect the world in which I live alongside my investment returns, and that's something that we absolutely have to support as this evolves into the future. So yeah, absolutely.
Desné, I know you've got some thoughts on this as well.
Yeah, I've actually once was invited by Dr. Andy Sloan, who developed, he's obviously the big champion of green finance in Guernsey, and he once invited me to come and speak at a forum there, and I was very excited about the things I heard happening in Guernsey. But, I think that both Guernsey and Jersey should signal to the responsible and sustainable EU investors that we've been talking about, that they have all of these great initiatives and that they are well-governed jurisdictions that score high on transparency with the OECD and with FATF, because especially with these Northern European investors who have contributed to the taxonomy and all of these developments we're talking about, they're still somewhat hesitant about anything offshore. And, this will become absolutely key. I think there's going to be more social pressure on tax transparency and substance, because this will become magnified under COVID-19, because revenues are dwindling, all over the world, and social tensions will increase. So it's really important for the Channel Islands to signal that they're very well governed offshore jurisdictions that are very transparent and score higher than some leading developed countries, on Moneyval and so on. And as Francis has pointed out, Guernsey's green finance is market leading. I think if I could give a suggestion to the Channel Islands, I think, we know this in London, we know the developments that are happening, but I think that there needs to be a lot more strategic communication in communicating these developments to global investors. And I think there's still a way to go there in terms of shouting about the really good work that's doing. Francis mentioned the fantastic Durrell initiative, the Jersey for Wilder World. I think that's really exciting, especially in the nature space. And I think something else that hasn't been mentioned that Jersey is doing in particular is it's making concerted efforts through Jersey Finance, led by Alan Wood, who's the business development head there, to drive development finance into the impact investing space in Africa. And this is the sort of, the European and US development finance institutions and institutional investors that are pushing for sustainable finance and for impact investing. They would really be interested in what the islands are doing in the space, and that the islands score a big G for governance, because those kinds of funds are very strict due diligence criteria. And I'd just say, I recently authored a report for Jersey Finance on domiciliation trends in the impact investing space, particularly for those people who are raising capital from Europe into Africa. And, you know, the thing that came up again and again with these kinds of LPs was that they were looking for stability and they were looking for good governance. And I think, you know, the kind of no change outlook that you have from Jersey and Guernsey in terms of stability, I think in the world of turbulence and misinformation, this is also something that you know, it's really, this is what investors are looking for in this space. And then I think finally, as you mentioned, you know, you're not quite in the UK, you're not quite in the EU, you're a third country, even though you're a crown dependency. And I think that contributes to the stability story. And I think this is something as well, I think maybe investors in the US and other jurisdictions don't know enough about your Brexit position. And that's actually a strength, given everything that's going on, you know, and I think being able to build on the sustainable finance would require a lot of stability.
Thanks, Desné. I've got a question which actually, looking at it, looks like it belonged earlier in the panel, I've got to say. It's a question about the challenges of the EU sustainability disclosures and whether they're, and the opportunities. And I feel like we might have partially covered that already. And a question about how they apply to funds and portfolio companies outside the EU. Did you want to say any more on that? And then before we hand to Vian and Stephen.
I just have a few brief points on this. I would say, you know, the development finance and impact investing space that I spoke about earlier, you know, as I mentioned, really an opportunity for, you know, to access this kind of EU capital, given the robust due diligence. So impact investing, big opportunities with the disclosure regulations. And obviously any fund or portfolio company that's looking to sell into the EU will have to be compliant. I think there's a, you know, the leadership in this space, it's kind of what is the global direction of travel? And I think, you know, there's an opportunity for a global kite mark. You know, if this really gains traction and we see that it's being implemented, which brings me to my final point. I think one of the major challenges is, and this relates to the greenwashing, you know, suddenly everyone is an ESG expert, but I really, I worry if we've got the requisite industry knowledge and infrastructure and experience and measurements and verification to actually implement all of these provisions properly. Are we actually ready? Are we ready for SFDR?
Just to add to that, Desné, thank you. I think you're right. However we want to cut this, we're relatively new in this ESG journey. And Steve mentioned, you know, we've been on financial disclosures for the last 100 years. Really, this is accelerating very rapidly in the ESG, and we're just at the beginning. So there are going to be opportunities, there are going to be known knowns, there are going to be unknown knowns, there are going to be things that we don't know at all which are going to happen, and we're going to have to flex around those. But as long as we maintain our integrity through this, we've got to support each other through it. I also think that the environment in the US will start to shift in this direction as well. I think there are opportunities for the world to come together. So yes, I think it's a very interesting moment. But yes, there will be challenges on the way, because we will have to learn along the way.
Yeah, and I think a lot of those challenges are down to quality data, to data gathering, as they have been for some time, and that's really is improving. But on the opportunity side, there's just so many, and I'm really positive of how quickly the uptake of the importance of sustainability and the risks of the massive capital destructions that's knocking at our door almost, and probably a lot quicker than many of us are aware. But the opportunities with all of these disclosures that the EU were bringing in, it also adds to an opportunity to identify risks such as physical risk and stranded assets. And if managers can make those risk assessments early and can act on them, that's going to be hugely valuable for their funds and therefore for their institutional investors who are making those investments. So the earlier there is uptake on these sorts of issues, then the more success that a lot of these fund managers will have.
Thank you. That's really interesting. What is everyone's best predictions on what's going to happen in the sustainable finance space over the next 5 to 10 years? Might start with Vian. What's your prediction over the next 5 to 10 years?
One word: growth. I think that there are all sorts of predictions out there with regard to growth. I think we've seen a tremendous growth in assets over the last 10 years. We're now at 40 trillion, 30 to 40 trillion in terms of how you measure what's managed with a responsible investment lens or a sustainable investing lens. Forecasts from various different people say double-digit growth over the next 5-10 years. Whatever it is, it's a growing area. I don't think it's going away. So it's very exciting for all of us.
I completely agree. Stephen, what do you think?
Yeah, agree. So sustainability, it's becoming the norm in terms of financial organizations' due diligence. So we've really seen a big push in that. And in addition to that is on the debt side, loans, bonds. There's the work that the loan market, LMA, Loan Market Association based in the UK, have done on the exponential growth in sustainability linked loans and green bonds is pretty exciting. And I dare say that will just be the norm. You won't really be talking about sustainability linked loans or green bonds in 5 years because they'll just be called bonds and they'll just be called loans. Which we're really looking forward to be a part of.
I agree. I was thinking, when will we get to the point where it's no longer called sustainable, that it just becomes the norm? And then you become an outlier, and there's you have a category of funds called the unsustainable funds, etc. And when is it going to flip? Desné, what do you think?
Absolutely agree with all of the points that we made before. I think my predictions are in the short term. Biden signed a whole lot of executive orders, almost immediately reversing the deregulation, particularly on climate, joining the Paris Agreement again. And I think we'll see massive, with increased regulation under the Biden administration. I think, the US is still one of the largest pools of capital, especially, in the space we're talking about on this call, private equity, real estate, and so on. I think we're going to see a lot of action in ESG coming from the US. I think something as well, sort of more of a macro point, medium term, is we don't talk a lot about China. And China's actually, when I worked at Global Council, we looked into like the history of sustainable finance. And China has actually been one of the key agitators towards sustainable finance in the global conversation. They've actually been the pioneer, and now with the Belt and Road Initiative, which like around 80 countries on the Belt and Road, and it spans all across Europe, China, Africa, Asia. And I think China, especially, having made the point about the US, China is set to become the biggest economy in the world. It's already expressing a lot of global leadership in the global South, and I think, it'll be interesting to see as China asserts itself more into the global economy, especially in the kind of capitalist market space, how people begin to understand, because people kind of have this view that China is, not really paying attention to sustainability, but it couldn't be more different. It's absolutely key to the Belt and Road strategy. Then I think that if you're a venture capitalist listening to this call, I think you should invest in vegan and plant-based companies and products, because I think that eating meat will become as morally questionable as investing in fossil fuels or flying unnecessarily. So I think that's going to become a big taboo, meat eating. And then finally, I've mentioned Africa a few times, and as we've had Brexit, Trump, and the US-China trade war, Africa became a lot more politically strategic. You've got an African heading up the World Trade Organization. I think we're going to see more impact investing. So, and also given just the big need for infrastructure development in Africa, that's going to be a very hot space in terms of where capital is going. And also, one thing that China is doing is helping Africa build capacity in order to build ESG governance framework. So that's going to be very interesting.
Fran, I think you had some thoughts on this too.
Well, I obviously agree with what everybody said. I mean, I think this is a very exciting time, and and we're only starting to see the gear shifting now. This is top down, bottom up. So we're going to see the shift. With regulators putting in place regulations that create incentives for long-term market investment in climate resilient infrastructure. The finance industry, they are going to be required to disclose and incorporate long-term risk into investment decision-making, implementing sustainable investment strategies, scaling up green financial instruments, and measure and report an impact. And then, of course, we've got at the bottom the individual investors who are demanding greener, more sustainable investments for their assets and for greater sustainability disclosure to increase accountability and transparency. And really, just to pick up on what we've already said, I mean, I think the thing that drives all of this is the technology that we now have to really hold people to account.
Thanks, Frances. And the final and killer question: where and how are your organisations planning to promote and lead in this space for the next 5 years or so? Where do you plan to make your impact? I might start, Stephen. Shall we start with you?
Yeah.
Sorry to have skewered you like that, but
we'll get GRESB. So we're into our 12th year this year. Very excited about that. We have 96,000 real estate assets participated and reported to us in 2020 over something like just over 1,200 portfolios. We expect a growth of, again, about 20-25% as we did last year. So within that, we remain a mission-driven organisation, very much investor-led by the industry for the industry, and we've set up we've just actually altered the structure of the organisation somewhat. So we've divided into two parts, and the most important part is the foundation that we set up. So that's will be filled by positions by all of our members, and they're made up of the large institutional pension funds and insurance groups, etc., around the world. A lot of the large fund managers and asset managers, and they're really pushing GRESB to go further, to do better, to get more of that granular performance data of these assets, so that it's a clearer, it's a better, transparent picture for the investors and for the managers. So that's what we're hoping to achieve in 5 years: continued growth, but also a better assessment, better data.
Well, I would say that for myself, one of the main resources I have as a professional is time. And in 2019, I said I want to spend 25% of my time in sustainable issues. This year, I've tried to make it 50%. I try to advise all my clients to be mindful of that. And I'm lucky that I can choose to work in, my day-to-day work. I can choose to work strategically with organizations and projects, or conversations like this, because I work in thought leadership and strategy. I can keep this on the agenda. I can influence other people to think about it, or, to start coalescing around particular issues. And then more practically, I have a podcast series. I do lots of articles. And in that kind of work, I try and give a platform to a diverse group of people by gender, nationality, ability, and in ethnicity. And then I don't want to steal Vian's thunder, but she's been using something called Eco Matcher, about which you can offset the carbon footprint of your various activities. I'll leave Vian to tell you about that, because it's very exciting what we can do practically.
No, well, thank you, Desné. And I think this comes back to the technology piece. So FNZ is a financial technology company. We are privileged to work with some of the biggest retail wealth platforms in the world. And the most exciting thing for us is, number one, being able to democratize information on the environmental and societal impact of portfolios, whether that be you as an end customer, us in our workplace pensions, or an institutional investor or an institutional pension fund looking at their actual impact and using the sorts of amazing data that's starting to come through in a transparent way. From that, that lever alone for me is the most exciting catalyst of change that we could pull. So things like EcoMatcher, how do we improve our footprint? How do we use technology to catalyze this shift in a responsible way? That's where we're investing our energies, and we are absolutely honored to be working with partners in this space, like the people around the table, like Fran's initiatives to try and move towards creating a world that we actually all want to live in the next 50 years.
That sounds very exciting. Fran.
So at Mourant Ozannes, we take, as an organisation, we take this issue really seriously, and it features prominently in our global strategy. We're increasingly seeing clients ask for our credentials before they'll instruct us, and candidates who want to join us are asking about this because they want to work for a business that takes it seriously and has appropriate policies in place. We've a global employee-led environmental and sustainability network, which brings together a green team in each office, and they each have responsibility for local initiatives in this area. In Guernsey, for example, we recently had a commuter challenge. And our offices, including and being led by Guernsey, are starting the process of seeking accreditation for our green credentials, although that's not been publicly announced yet, so I'm probably not allowed to say too much more about that, but it's very important.
Thanks, Fran. I think that's in some ways the most exciting part of the call, listening to what we're all individually thinking about doing and wanting to do, because isn't that where it's all driven from? Individuals' passion and desire to make a real change in this area and really push our businesses and our industries forward so we can all make a difference. Thank you very much for coming on this panel today.
Thank you.
And talking. I found it really fascinating.
Thank you.